Finance refers to the management of money and financial resources. It encompasses a wide range of activities, such as budgeting, forecasting, accounting, and investing. Finance is a crucial aspect of any business, as it allows business owners to make informed decisions about how to allocate their resources and grow their company. For small business owners, understanding the basics of finance is particularly important. Small businesses often operate on tight budgets and have limited resources, which means that financial mismanagement can have serious consequences. By mastering the fundamentals of finance, small business owners can make better decisions, manage their cash flow effectively, and position themselves for long-term success. This video is designed to provide small business owners with a comprehensive overview of the basics of finance. We will cover the key concepts that every small business owner should know, including financial statements, budgeting and forecasting, cash flow management, and financing options. Whether you're just starting your business or looking to improve your financial management skills, this video will provide you with the knowledge and tools you need to succeed. So, let's dive in. The role of financial statements in business. Financial statements are critical tools for small business owners to monitor and evaluate their financial performance. These statements provide a snapshot of a company's financial health and help business owners make informed decisions about future operations. There are three main types of financial statements: balance sheets, income statements, and cash flow statements. A. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It includes a summary of assets, liabilities, and equity. Assets are anything a company owns that has value, such as property, equipment, or inventory. Liabilities are the debts and obligations that a company owes, such as loans, accounts payable, or taxes. Equity is the value of a company's assets minus its liabilities, and it represents the value of the company that belongs to the owners. B. Income statement. The income statement summarizes a company's revenues and expenses over a specific period of time, typically a month, quarter, or year. Revenues are the amounts earned from selling goods or services, while expenses are the costs associated with running the business, such as salaries, rent, and supplies. The income statement provides an overview of a company's profitability by subtracting expenses from revenues to calculate net income. C. Cash flow statement. The cash flow statement shows the inflows and outflows of cash in a business. It includes information on operating activities, such as cash received from customers and paid to suppliers, investing activities, such as cash spent on buying or selling assets, and financing activities, such as cash received from loans or payments to shareholders. The cash flow statement is crucial for understanding a company's liquidity and its ability to pay debts. To interpret financial statements, it is essential to understand key financial ratios and metrics, such as liquidity ratios, profitability ratios, and solvency ratios. For example, the current ratio, current assets divided by current liabilities, measures a company's ability to pay its short-term debts, while the debt-to-equity ratio, total debt divided by equity, shows how much debt a company has relative to its equity. Financial statements are important for small businesses for several reasons. First, they provide a way to track financial performance over time and identify areas where improvements can be made. Second, financial statements are necessary for securing financing from banks or investors, as they provide evidence of a company's financial health. Third, financial statements help business owners make informed decisions about budgeting, forecasting, and planning for future growth. By understanding financial statements and using them to inform decision-making, small business owners can set their businesses up for long-term success. Budgeting and forecasting. A. Importance of creating a budget and forecasting financial performance. Creating a budget and forecasting financial performance are essential for small businesses to plan and manage their finances effectively. A budget is a financial plan that outlines expected revenues and expenses for a specific period, while financial forecasting predicts future financial performance based on historical data and trends. By creating a budget and forecasting, small businesses can anticipate future cash flow needs, identify potential problems, and make strategic decisions to achieve their financial goals. B. Explanation of key financial metrics: revenue, expenses, profit, cash flow. There are several key financial metrics that small businesses need to track and monitor regularly. Revenue is the total amount of money earned from sales of goods or services, while expenses are the costs associated with running the business, such as rent, salaries, and supplies. Profit is the difference between revenue and expenses, and it represents the amount of money a business earns after all costs are accounted for. Finally, cash flow is the amount of cash that flows in and out of a business over a specific period, and it is crucial for ensuring that a business has enough cash to meet its obligations. C. Tips for creating an effective budget and forecast. To create an effective budget and forecast, small businesses should consider the following tips. 1. Use historical data and trends to predict future performance. 2. Break down revenue and expenses into categories to identify areas of strength and weakness. 3. Consider various scenarios and potential changes in the business environment to prepare for unexpected events. 4. Involve key stakeholders in the budgeting and forecasting process to ensure buy-in and alignment. 5. Regularly review and adjust the budget and forecast as needed to reflect actual performance. By following these tips, small businesses can create a realistic and actionable budget and forecast that helps them achieve their financial goals and plan for the future. Managing cash flow. Cash flow management is critical for small businesses to ensure that they have enough cash to cover their expenses and operate effectively. Cash flow refers to the movement of money in and out of a business, while profit is the difference between revenues and expenses. Understanding the difference between cash flow and profit is essential because a business can be profitable but still experience cash flow problems if it does not have enough cash on hand to cover its expenses. A. Common cash flow challenges for small businesses. Small businesses often face cash flow challenges, such as late payments from customers, seasonal fluctuations in revenue, unexpected expenses, and slow paying accounts receivable. These challenges can create a cash flow gap, where a business has more cash going out than coming in, and can lead to financial difficulties if not managed effectively. B. Strategies for managing cash flow, including accounts receivable and accounts payable. To manage cash flow effectively, small businesses can implement several strategies, including 1. Improving accounts receivable management. This involves setting clear payment terms, following up on overdue payments, and offering incentives for early payment. 2. Managing accounts payable. This involves negotiating payment terms with suppliers, prioritizing payments based on importance, and taking advantage of early payment discounts. 3. Monitoring cash flow regularly. This involves tracking cash inflows and outflows, forecasting future cash flow needs, and adjusting spending as needed. 4. Creating a cash reserve. This involves setting aside cash to cover unexpected expenses or short-term cash flow gaps. 5. Managing inventory levels. This involves keeping inventory levels optimized to avoid overstocking or stockouts, which can tie up cash. By implementing these strategies, small businesses can improve their cash flow management and avoid financial difficulties caused by cash flow gaps. Financing options for small businesses. Small businesses may require additional financing to fund their operations, expand their business, or invest in new projects. There are several financing options available for small businesses, including loans, lines of credit, and equity financing. A. Explanation of common financing options. 1. Loans. Loans are a common financing option for small businesses. 1. They involve borrowing a specific amount of money that must be paid back over a fixed period, usually with interest. 1. Loans can be secured or unsecured, and they may require collateral. 2. Lines of credit. Lines of credit are a type of revolving credit that allows small businesses to borrow money as needed up to a certain limit. 2. They are flexible and can be used to fund short-term cash flow needs or unexpected expenses. 3. Equity financing. Equity financing involves raising capital by selling ownership shares in the company. 3. It can be an option for small businesses that need a significant amount of funding, but it also means giving up a portion of ownership and control of the business. B. Pros and cons of each financing option. Each financing option has its own pros and cons, and small businesses should consider their specific needs and circumstances when choosing the right option for them. Loans offer a fixed amount of funding with a set repayment schedule, but they may require collateral and can be difficult to qualify for. Lines of credit are flexible and can be used as needed, but they may come with higher interest rates and fees. Equity financing can provide a significant amount of funding without requiring repayment, but it means giving up a portion of ownership and control of the business. C. Tips for choosing the right financing option for your business. When choosing a financing option, small businesses should consider the following tips. 1. Determine your funding needs. Consider how much funding you need and for what purpose. 2. Evaluate your creditworthiness. Understand your credit score and history to determine your eligibility for loans or lines of credit. 3. Research your options. Compare the pros and cons of different financing options and understand the terms and requirements. 4. Understand the costs. Consider the interest rates, fees, and repayment schedules associated with each option. 5. Seek advice. Consult with financial experts or trusted advisors to help you make an informed decision. By considering these factors, small businesses can choose the right financing option to meet their specific needs and achieve their financial goals. In conclusion, managing finances effectively is critical for the success of small businesses. This video has covered several key topics related to finance for small businesses, including the role of financial statements, budgeting and forecasting, managing cash flow, and financing options. A. Recap of key takeaways. Small business owners should remember the following key takeaways from this video. 1. Financial statements provide valuable information about a business's financial health and performance. 2. Budgeting and forecasting can help small businesses plan for the future and achieve their financial goals. 3. Effective cash flow management is critical for small businesses to avoid financial difficulties and maintain their operations. 4. Financing options such as loans, lines of credit, and equity financing can help small businesses fund their operations and achieve growth. B. Encouragement to prioritize financial management. As a small business owner, it's essential to prioritize financial management to ensure the long-term success of your business. By understanding the basics of finance and implementing sound financial management practices, you can improve your business's financial health and achieve your goals. C. Additional resources. If you want to learn more about finance for small businesses, there are many resources available, including 1. Small Business Administration, SBA. The SBA provides free resources and tools for small businesses, including financing options, business planning, and financial management. 2. SCORE. SCORE is a nonprofit organization that provides free mentoring and educational resources for small businesses, including finance and accounting. 3. Financial management software. There are several financial management software options available, such as QuickBooks and FreshBooks, that can help small businesses manage their finances effectively. By taking advantage of these resources, small business owners can continue to improve their financial management skills and make informed financial decisions for their business.